Not for the first time, the world awaits a US-Iran deal that might help get oil flows moving again. But analysts argue a breakthrough wouldn't change much of the rapidly approaching round of central bank meetings. It's another big week in markets. And if the reports are true, the US and Iran are close to a deal that reopens the Strait of Hormuz, while thorny issues of uranium and sanctions relief appears unanswered. Those are frankly evergreen sentences that could have been written at almost any point over the past 2 months. Still, let's take it at a face value. If the strait reopens and oil flows resume, does everything simply snap back to normal? Markets are already leaning that way. Stock markets are at new highs, and 2-year swap rates, a proxy for short-term policy expectations, have tracked crude prices almost tick for tick through its crisis, and they're starting to retrace. Still, central banks themselves could be slower to change course. Even with the deal, oil prices might not have much further to fall. The market will be down by upwards of 1.6 billion barrels when this is all said and done. Strategic reserves will need replenishing. Production facilities need to be repaired. Analysts still don't think oil prices will fall below $90 per barrel this year, even if oil flows return close to normal by July. Gas tells a similar story. Analysts have been warning that Europe will start to face more competition for LNG flows from Asia. That's going to keep pressure on prices across the continent. Central banks are well aware of this risk, and the Bank of England governor has warned that gas markets look too optimistic. Does the deal really reopen the strait in full, even if that's what is reportedly promised on paper? Well, the risk of stop-start disruption is likely to remain high. Will shipping firms and insurers be willing to return, and at what cost? With every passing day, this crisis, now entering its 4th month, will embed itself more and more into supply chains and pricing behavior. Central banks, particularly the European Central Bank, have spent weeks signaling that they would act if the conflict dragged on. Well, it has. And they will be worried that markets will start to think they are all bark and no bite. The Bank of England is more interesting. The case for hikes has always looked less compelling. A hike is still possible in July if the situation in the strait hasn't been durably resolved. Analysts don't expect central banks to sound the all clear yet.